Before we dive into today's topic, let's take a moment to reflect on a crucial trend unfolding in our financial world. Recently, RBI Governor Shaktikant Das highlighted a significant shift in how Indian households manage their savings. Increasingly, people are moving away from traditional bank savings accounts and investing more in mutual funds, equities, and other financial intermediaries. This change indicates that Indian banks are currently experiencing one of the most challenging credit crunches in their history. So, what are the reasons behind this shift? Let's break it down. With saving habits on the decline and inflation eating into the little savings people do have, more and more individuals are choosing to invest their money in mutual funds and equities rather than keeping it in bank accounts. However, data from SEBI suggests that many newcomers are losing money in the stock market because they lack the knowledge to select the right stocks or companies. This highlights the importance of understanding a company's fundamentals and valuation to avoid costly mistakes. In this scenario, fundamental analysis of the stocks becomes very crucial. Now, you might be wondering what happens to the banks in this scenario. To give out more loans, banks need more deposits, but without sufficient deposits, how can banks survive? In today's video, we will explore whether banks need to pivot their business model or risk becoming obsolete. Hello, I'm Rohit and I welcome you to today's video. To understand the current situation of banks, we must first understand how they make money. Banks' profit comes from the net interest margin or the interest spread. To understand this, you must first understand that banks pay interest on the deposits they receive in forms of savings plans or fixed deposit and they lend this money out at higher interest rate. The difference between the interest paid to the depositors and the interest received from loans is the bank's net interest margin. For instance, if a bank has deposits worth 100 crore, it cannot lend the entire amount due to RBI regulations like cash reserve ratio CRR and the statutory liquidity ratio SLR. Currently the CRR is 4.5% and the SLR is 18%, meaning banks can only lend around 27.5% of their deposit. The deposits that banks receive are categorized into two parts. CASA, current accounts and saving accounts, and FD, fixed deposit. Banks prefer CASA deposits because they pay minimal interest rates on these accounts compared to the higher interest rate on FDs. Let's take a hypothetical example. Suppose ABC Bank has deposits worth 1000 crores with 500 crores from CASA and 500 crores from FDs. If the bank pays an average of 2% interest on CASA and 8% on FDs, the total interest payout would be 10 crore rupees for CASA and 20 crore rupees for FDs, totaling 50 crore rupees. Now, if the bank lends out 775 crore, that is 77.5% of 1000 crore rupees, at 12% interest, they earn 93 crore rupees, resulting in a net interest margin of 43 crore rupees. The higher the CASA ratio, the better it is for the bank's profitability. However, with the decline in CASA deposits during the recent years, banks' margins are under pressure. Data shows that the mutual fund industry's asset under management (AUM) have grown from 9.75 lakh crore in 2014 to 61.6 lakh crore in 2024, a growth of over 527%. Similarly, the number of demat accounts has increased from 2 crore in 2015 to 15 crore in 2024, indicating a substantial rise in retail participation. Deposit growth at around 11% and loan growth at a staggering 177.5%. It's evident that people are investing more in mutual funds and equities, and banks are facing increasing stress. This situation has led to speculation about potential changes in government policy, such as increased taxes on long-term and short-term capital gains and share buybacks to encourage more people to keep their money in banks. Banks have tried to counter this by offering zero balance accounts, but this move has backfired as it diminishes a significant income source, which is minimum balance charges. For example, 11 public sector banks earned 22,331 crore in 2024 from minimum balance charges alone, with PNB earning 633 crore from this source. With recent demands for more customer-friendly policies, SBI has already abolished its minimum balance penalty, and it's likely that other banks will follow suit, potentially cutting off a substantial income source. Does this mean the end of the traditional banks? Not necessarily. Banks will need to innovate and adapt to stay relevant. The winners in this race will be those who invest in IT infrastructure and digital services, moving away from a focus on physical branches. In the age of instant digital services, today's generation has little patience for traditional banking methods. Banks that embrace digital transformation and explore alternative funding sources will be well positioned to thrive in the future. Banks with a strong reputation can leverage this to secure funding from international markets at lower interest, allowing them to lend at competitive rates to customers. This could be the new model for banking, where the key to success lies in building trust and offering innovative solutions. The CASA ratio is likely to decline further as people seek better returns from short-term debt funds and liquid funds. Even fixed deposits, which were once the cornerstone of bank savings, have become more flexible and convenient for customers. People are becoming more aware of their investment options. Thanks to digital platforms and finance influencers, they know where to invest for better returns and to easily beat inflation. In conclusion, banks will need to be highly innovative and creative to navigate the tough times ahead. The struggle that NBFCs face today might be the challenge banks encounter in the near future. The difference between banks and NBFCs is the CASA ratio, and if that diminishes, banks will operate more like NBFCs. Banks must awaken from their slumber and figure out new ways to innovate and grow. The lending industry is expanding rapidly, and a bank that sees the opportunity and finds solutions will emerge as the real winners. The potential for growth is immense, and the banks that act swiftly will dominate the market in the coming years. The opportunity is before you. The problem is clear and the solution is within reach. Now it's up to you to observe which bank implements the right strategies and leads the way into the future. Subscribe to our channel to stay informed about the latest in business, finance, and world economy.